Welcome to Views from the North, a Canadian rates and macro podcast. This week I'm joined by Robert Kavcic, one of our senior economists in BMO Economics. This week's episode is titled Canadian Housing, the End of an Era. I'm Ben Reitzes, and you're listening to Views from the North. Each episode I will be joined by members of BMO's FIC sales and trading team to bring you perspectives on the Canadian rates market and the macro economy. We strive to keep the show as interactive as possible by responding directly to questions submitted by our listeners and clients. We value your feedback, so please don't hesitate to reach out with any topics you'd like to hear about. I can be found on Bloomberg or via email at benjamin.reitzes@bmo.com. That's benjamin.reitzes@bmo.com. Your input is valued and greatly appreciated. Rob, welcome back to the show. It's been a while, but you're my favorite guest here to have on for all things housing. It's kind of moved to the back burner a little bit, I think, over the past few months, but it is still topical, and people in Canada still are very much focused on housing. In fact, a friend of mine has been texting me, I think on a multiple times per week for the past 2 weeks, asking me when to renew his mortgage and what rate to do that at, fixed, variable, yada, yada, yada. So housing, mortgages, all that stuff. Welcome back.
Thanks for having me, Ben. It's an honor to be your favorite guest on the topic of Canadian housing.
Favorite housing. He knows more than I do, so that's the point of bringing guests on. So actually, you know what? Before I make my point here, that may be controversial, why don't you tell us how you view the state of the Canadian housing market at the moment? I guess, where were we pre-tariff? Because that's probably an important way to look at things, because things have changed a little bit in the near term with the tariff announcement and how that's impacted the economy. Where are we at present, again, with those tariffs in place? And then where do you think we're going over the next, call it 3 to 6 months, assuming you get some kind of trade deal, and then we can tackle the multi-year outlook after that?
Yeah, so the market overall is not doing a whole lot. It wasn't doing a whole lot pre-tariff. It's probably behaving a little bit worse now post-tariff, just because of the impact we've seen on consumer confidence and stuff like that. A lot of people freaked out by the headlines. Do you want to go and make a potentially huge purchase at a time when you don't know what the economy is going to look like? Probably not. So there's arguably some activity held back because of that. But bigger picture, I mean, it's just the reality of the market's still adjusting to higher borrowing costs. Demand is still pretty low. We're seeing sales activity kind of bounce around, the low end of the last decade range, put it that way. And there's a lot of supply coming on the resale side of the market. You're seeing pretty good listings flow. And on the new side of the market, the pipeline of projects that are coming to completion is large, right? And so that's spilling over onto the resale market because a big chunk of that has been investor owned. We can go through the investment mechanics later on if you want, but it doesn't make any sense from an investment perspective right now. So that aspect of the market is really dried up, right? Somebody who potentially bought a place back in like 2020, 2021 pre-construction as an investor, they're not holding that at negative cash flow right now. So that's getting flipped onto the market as well.
Or trying to get flipped onto the market.
Yeah. So, and that's the other distinction here too, right? So the Canadian numbers or the Canadian market condition overall could be pretty flat and not doing a whole lot, but you'll have areas like Calgary or Edmonton or Atlantic Canada, Montreal that are actually performing still pretty well. But you get into the Vancouvers, the Torontos, most of Southern Ontario, things are pretty soggy. And then if you go even deeper, if you go into, let's say, the 600 square foot condo market in a market like the GTA, that's a recession, okay? Like it is what it is. That market is seeing a ton of supply, zero investor demand, and prices coming down.
So one of the first things you mentioned is that sales activity is at the low end of the 10-year average. Curious if the 10-year average is even something we should be looking at, because the past 10 years and kind of the really post-financial crisis through to the early part of the pandemic until inflation exploded was characterized by extremely low interest rates on a persistent basis, which then pushes up activity. So like the past 10 years don't necessarily reflect accurately where home sales should be, because we have way more people in Canada than we did 10 years ago. And so like on a per person basis, on a per capita basis, home sales should just slowly rise over time, but they haven't really. If we're below the 10-year average, then clearly we haven't. And there was a big step up in the pre-financial crisis into the financial crisis time, like just after even actually There was a big step up in the post-financial crisis era as rates came all the way down. And then we kind of held at those levels, and now we're back down a little bit. And where I'm going with this is, I guess, like, should we even be looking at any recent history as a comparable? Or are we in a different enough place that all the historical comparables aren't really useful and we should just can them at this point and just not really expect all that much?
Yeah, it's a reference point, right? So you're right. Population is bigger per capita basis. We should have higher sales. So if we're at the low end of that range with a higher population, it kind of just speaks to how little demand there is out there right now. There are other factors too. Like during the pandemic, there was a lot of, let's say, movement. So not necessarily more people, but even just people transacting and moving. If it was, let's say, even just selling in Toronto and buying in Kitchener or in Calgary. It's the same number of people, but it's just more transaction volume, right? So a lot of that's dried up too.
I just bought a hot tub instead. It was cheaper. Okay, so how are things different? We had, I guess, very specific set of circumstances unfold over the past 20 years for Canadian housing. And those circumstances led way too many people to use housing as a source of income, to flip houses, to basically obsess with the housing market generally. And I think, is that time over? Is this the end of the era of Canadian housing exuberance?
This is a big question. We're probably going to cover a few things here. Okay, so jump in as we go along. First and foremost, the big change post-pandemic was we normalized interest rates. And for the first time, an entire generation has realized you can have a housing market correct. We haven't seen a housing correction in Ontario since the early 90s. That was my father's generation. Anyone our age and behind us has never seen house prices really decline outside of maybe like a Calgary or a specific pocket. So the first time they've learned a lesson that, oh crap, there's risk in this market. Okay, so that
prices can fall?
Psychologically, that itself is going to reset the market, right? And just the froth and the investment dynamic that play out in that market. So yes to that.
That's where we're thankful that we have regulators that have been responsible. We haven't, and we're not going to have a U.S. type crisis that they did in the financial crisis because they wrote irresponsible loans, irresponsible mortgages. That's just not the case here. So at that time, it was also prices never go down. U.S. home prices never go down. Same way Canadian home prices seemingly never go down, except for, oh wait, they do. And so now here we are. So what else? What are the other drivers here?
So the other things I would consider here is to keep in mind what happened at the absolute max in late 21, early 2022. Interest rates were down at zero. Real borrowing costs were deeply negative. Okay, we're going to not go back there. Presumably neutral rates are higher going forward, right? I think we can agree on that.
I definitely do.
So we're not going back to 1.5% borrowing costs. So we're sitting around 4%. So that's part of it. The other part of it is two parts on the demographic side. We had extraordinary population growth from international immigration that peaked through 21, 22 into 2023. Policymakers looked at this and said, oh, hey, this is a demand problem. Let's solve that. And they did.
Self-created demand problem.
Okay, so that's that 3%, 1.5 million people per year population growth is also behind us. We're settling back into let's call it 1% after a couple of years of normalization, but that's a much different story than 3% because 3% stresses supply and pushes prices up. 1% is about manageable, right? It's about the balance that we're going to see between supply and demand. So that's gone. And then the other aspect of the demographic curve is the Canadian millennial. So let's say the peak of that cohort being about 32 or 33 years old as we got into 21 and 2022. And what are you doing by the time you get to your mid-30s? You're having your first, your second. In our case, you're having your third kid, right? You're looking for a bigger house with a backyard. That maxed out right at the same time when we had international immigration surging and deeply negative real interest rates. So all those factors came together at once. You project that forward, what happens? I mean, demographics are easy, right? If I'm 36 today, I'm 37 next year. We know that's a fact.
Are you sure?
So as we go over the next decade, that millennial has already rolled through their home buying year. So incrementally, you're not adding that level of demand anymore. And we saw the same thing when we went late 80s through the early 90s.
That was going to be my next question is okay, go back, I guess, 35 years when it was the baby boomers and they got the same type of thing. Housing did quite well through the 80s. I believe rates made it a little bit more challenging, but it did all right. And then it didn't.
The funny thing is that my father was a builder during that period. The narrative was exactly the same. It was international immigration. It was demand from, at that time, as you say, the baby boom. It was not enough land, not enough supply. We need to build, build, build. And interest rates rose. The demographic curve rolled over, just as we're kind of seeing right now. And what had happened, we went through 10 years where the market corrected and then did nothing.
Are we going to repeat that cycle? Is the next 10 years going to be as weak for housing as the 90s? And does that mean that, dare I say, the stupidity of housing in Canada will actually fade for a while and we can actually focus on more productive matters?
I think on the second part, yes. The obsession is probably going to be put behind us because the conditions aren't there, first and foremost, and the psychology has changed, which was a very important part of this, right? We've talked about this a lot. The 90s was a really bad period, though, for the economy, right? So you had a deep and long-lasting recession. We don't have that right now.
Hopefully not.
You had a fiscal crisis, currency crisis, arguably forced Bank of Canada tightening and a jump in real rates middle of that decade that prolonged the recession and prolonged the housing slump. We're probably not going to see that now. I mean, you never know, but at this point, that's not happening now.
Unlikely.
So my view on this would be kind of it's a softer version of the 1990s where, yes, the demographics have changed, the psychology has changed. It's not a deep and prolonged housing recession, but this market goes sideways for a long time. And we're talking years, we're not talking months.
You mentioned we're still going to have modest population growth. Where does that leave, and this is going to be a much harder question for you to answer, where does that leave the narrative that we are massively short on housing? We need to build a gazillion more units, as some people would like to say. I'm clearly the other way, if you can't tell by my sarcasm. I think this is more of a type of unit problem than an actual number of unit problem. We've built too many boxes and not enough houses. And families don't want to live in a box downtown. And that's it. And the reason we don't have enough houses is because we can't get to them. Because you can't build them outside of the major city centers because our transit system's horrendous. And governments have ignored that for way too long. And now there's stuff being built, admittedly, like Ontario is actually building a decent amount of subways and rails and stuff like that. But I don't even know when they're going to come online. And you look at the crosstown rail line they're trying to build, whatever it's called, and it's how many years behind? It was supposed to open in 2022, it's a few years minimum, and it's done. It's amazing because I drive by the stations and they're fenced off and they actually look really nice. They're really nice looking stations, but somehow it's still not open, even though everything looks as if it's done. Because I mean, who knows why? This is the Canada problem. So I guess what's your view on all of that? Since now you have mine.
So there are a lot of questions there too. So I guess at the highest level, you always hear the numbers from CMHC. They'll probably update those, that we need 3.5 million units by 2030, up and above what we're already building as a baseline. First of all, it's never going to happen, right? The industry has been operating at full capacity through the housing boom. You can't triple output without massive inflation consequences, right? So that's, regardless of if that number is correct, it's not going to happen. And also that number is probably not correct anyway. So
Thank you.
We don't have to get into all of the details, but underlying those numbers are this view that housing was affordable back in the early 2000s, and that's where we need to go back to. So that was at the tail end of a 10-year housing bear market. First of all, we talked about that. That would be similar to saying, oh, U.S. housing was affordable in 2012, right after the financial crisis. So that's not the benchmark you want to go back to. It's not a benchmark we can go back to anyway, because that was before a lot of legislation that came in and really closed off areas like Toronto and prevented single attached housing supply. So we've seen a big increase in like just scarcity of single attached housing since then because of development constraints.
And that's driven unaffordability.
Exactly.
So like I should have made this point. Like I don't argue that housing is affordable. Like it is not affordable. Unaffordability is clearly an issue, but building more boxes in the sky is not going to solve that problem. That is pretty clear to me. It's worth talking about the investor dynamic because I think that matters a lot. Like prices, rent, rates, those three go together to make up affordability at the end of the day. And the fact that prices are well off their highs and continue to fall is very telling. And it's not just condos either that are down. It is single families are down as well. There's 3 houses on my street that are currently for sale, and I don't remember that ever being the case, ever. And there's a wide spread in the pricing of those houses. And the lowest one already dropped their price, and I honestly don't see any of the 3 selling. So it's gonna be interesting times for sure.
Well, look at why the investor is gone. Okay, so this is what happened basically. Investors bought something pre-construction, let's say 2021. What were they going to do? And this was probably like 30, 40, maybe almost 50% of some projects in the GTA. What were they going to do? They were going to flip the contract and assign it. That market dried up, right, when the market rolled over. So they can't do that. What's the next thing they can do? We'll just sell it on completion. Well, prices are down 25%. You can't do that without taking a big equity loss. So they're not going to do that. Or at least they don't want to do that. What's the next thing they can do?
Not just that, they probably owe the bank some money at that point.
Right.
You're going to be down where your deposit is and then some.
So what's the next thing they're going to do? They're going to just, the rental market's great. I'll just put it on the rental market. Well, cash flow mechanics at 1.5%, which was the rate that was in place when they bought the place pre-construction, doesn't make sense anymore at 4% borrowing costs. You're going to have to swallow at least $1,000 a month cash flow negative, depending on your property. And what else is happening? There's a pipeline of that supply coming at us right when policymakers have put a cap on rental demand through NPR caps. So rents are actually falling like 10% year over year in the GTA. That doesn't work. So what happens? It gets flipped onto the resale market, and you have, a flood of both new and resale condos hitting the market in the GTA. And the investor is watching this and, fine, when prices are rising 30%, I could swallow cash flow for a few months or a year, and I'll just sell it next year. But prices aren't rising 30%. So those properties are getting sold.
Uh-oh. Or listed and not sold, and prices just continue to fall. We've been, the latest little part of our conversation has been very Toronto, / Vancouver centric. The rest of the country looks a lot better, don't they? Is that going to change, I guess? Like they've been more resilient because of population flows have really helped. They helped Atlantic Canada. They've helped Alberta a lot. And that's helped drive their housing markets. As we get national population growth slowing, I'm going to assume that those areas also get less population flow, as I think we saw in the second quarter. And so does that mean those markets are also poised to slow down a little bit?
I think so. They're much healthier to start with. And proportionally, so the vast majority of the population slowdown is going to be through non-permanent residents. And proportionally, it's Ontario and BC that stand out. If the share is 7% now and the Feds want it at 5%, disproportionately, Ontario and BC have to swallow most of that decline. So there's that. They're a little bit sheltered from that perspective. There's also still flow of people out of, let's say, Vancouver and a Toronto towards like the Calgarys and Atlantic Canadas, which has supported those markets. Kind of think that is going to run its course a little bit. You're already seeing the migration numbers to Atlantic Canada back off. Alberta is still pretty solid. Alberta is really kind of the one province that stands out because they have economic strength and real job prospects plus housing affordability. So they look pretty solid. But a lot of that arbitrage has kind of been priced out, right? Especially now with you have prices in Calgary at record highs and you have a lot of Southern Ontario like 20, 30% off the high. The case isn't as compelling as it was before.
Not only that, you probably can't sell your house in Southern Ontario if you want to. At least not at the price you thought it was worth.
Yeah. So I think they'll still outperform, but they're also balancing out and probably slowing down a little bit over the next year.
Okay. That all makes good sense to me. And I guess with like medium term, if as you say, neutral is a little bit higher, which again, I do think it is, then we have, I guess, what I would call a pre-financial crisis normal rate environment. My first mortgage was in 2006, five or six, I never remember. 4.097%. Yes, I remember the third decimal. And that I was like I remember being pretty happy at the time. So that feels like we're back to that kind of ballpark, more or less. And I mean, even very near term, if we get the bank cutting one or two more times or whatever, I'm not sure how much mortgage rates even fall from here, maybe 10, 20, 30 basis points tops, but then you're down to still north of 3.5%, which is nowhere near the crazy levels you got during the pandemic or kind of post-financial crisis for that 10 plus year period. So
yeah, and that's the kicker in this. When I do the arithmetic on affordability or on just the investment calculus, if you can get down to like 3 to 3.5, things start to, I don't want to say they're favorable again, but they
look
stop
less bad.
they stop making no sense, right?
Okay.
So I think if we see rates hit that, you would probably see the market tighten up pretty quickly. I like you said, I don't think we're getting there.
That's a long way down from here. You almost need a negative enough economic scenario where even if you got it, that wouldn't be enough. But it would certainly act as a cushion for that negative economic shock. But I'd much rather us shift our focus away from housing as a country and maybe build more productive stuff like pipelines and mines and things that we have an abundance of that Canada can be good at. But we'll see what the government does going forward. I guess that your view on housing means the government's plan to step in and build houses may be slightly ill-timed.
Honestly, don't know what we're going to possibly do if we were going to build 3.5 million houses up and above the rate we're producing out right now. We'll be swimming in supply for years and years and years.
And
the wrong type of supply.
That's it. So that's the big part of it for me is the type of supply does not help the affordability picture, and that's what makes it really hard. Unless everybody's happy to go move into condos, but even then, most of the condos aren't sized appropriately for families. So it makes for a pretty challenging market. One last question before we wrap up: how much further do you think prices have to fall? And if you want, because it isn't really a fair question because of the geographic differentials between everywhere, it makes it really hard to say. But you could lump Toronto, Vancouver together, and then do like a Canada X those two.
Let's say this. Let's say Toronto, Vancouver, parts of Southern Ontario in the condo space, which is probably the worst case that we're looking at here. I could easily see 10 to 15%.
Okay. I was going to lean over, but I guess with 15, that's still a long way down from here when they've already fallen pretty decently as it is. Single family?
Single family, it's tough because single family gets hit hard when affordability is a challenge, but I also do still believe that there's a scarcity trade there as well. So ultimately, they're going to find a floor.
Yep.
I would say less than that on single family.
5 to 10% would be reasonable.
I would think that's about right. And then as you get into like areas where there's no valuation stress to begin with, like the Calgarys, the Montreals, Atlantic Canadas, not a whole lot either way. I think those markets are probably peaking out, but not a whole lot either up or down.
I guess the fact that they're able to hold their ground over rates are now, if rates come down a bit more, that helps. And if rates go up, whatever, not a whole lot over the next couple of years like that, that'll be on the back of economic strength. And so there'll be no reason for them to meaningfully back off. But they've done a fair bit of catch up, and the basis between Toronto, Vancouver, and everywhere else in the country has tightened a lot. Maybe there's a little bit more to go there, but probably the bulk of it might be behind us for now. So hopefully we do have a better outlook here, not for housing, but for Canada in general. And we can focus on things like I said, more productive, parts of the economy, I guess, rather than housing, instead of focusing all our time there. And the only downside is we'll have fewer housing podcasts, but I think that's okay.
You'll find something to talk about, I'm sure.
Excellent. Rob, thanks for coming on again. Very much appreciate it. And maybe next time we'll talk about Provies instead, because housing will be less topical going forward. Thanks again.
Yeah, man.
Thanks for listening to Views from the North, a Canadian rates and macro podcast. I hope you'll join me again for another episode.
The views expressed here are those of the participants and not those of BMO Capital Markets, its affiliates, or subsidiaries. For full legal disclosure, visit bmocm.com/macrohorizons/legal.